Great. Thank you very much. I think we are going to try and make it a bit more exciting. I know you heard some fantastic speakers over here talking about succession planning to investment opportunities, but we just thought we'll try and mix it up a bit. So the background to this particular session is all about allocations. And obviously we are in a place and time where the standard allocations for family businesses are, let's just put it this way, slightly open for question. Whether we're talking about the macroeconomics or we're talking about the inflation or the election that has happened, it's causing for a lot of family offices to rethink where and how and in which format to actually invest. Me personally, I'm trending towards some interesting opportunities. But we just thought that it might be a good idea to have two sets of teams arguing for people who want to actually keep on investing and perhaps even increase the investment in traditional securities such as public equities, real estate, fixed income, so on and so forth. And my colleagues on the right will be arguing for that position. And on my left, my colleagues will be arguing about and debating about alternative assets. We will be following the Oxford debating style, in which each of the participants will be given 3 minutes to give their arguments. And then the opposing side will start and give their arguments. And then each of the teams will have a chance to rebut what the other team has mentioned. We will wrap up and off we go. So, without further ado, I'm going to ask my colleagues on my left, starting with Christina, if she wants to kick off.
Sure. Traditional securities are no longer enough to ensure growth or resilience for institutions in traditional markets. It's necessary for institutions to diversify into alternatives like venture capital, digital assets, and fund management. Alternatives are reshaping the new global financial markets. It's the new norm, offering high yield diversification and innovative market entries with technologies backing. With that said, it's crucial for the capturing of asymmetric returns and future-proofing your wealth. 61% of family offices are actively seeking into new investment opportunities. Digital assets and tokenized assets unlock liquidity and returns from traditionally illiquid real estate and private equity. The alternative investment space is bound to grow from 15 trillion into 24 trillion market by 2028, signaling a remarkable shift from beyond traditional asset classes. The market cap of digital assets alone is currently 5 trillion, presenting an exponential growth for stablecoins alone, accumulating $190 billion. We all heard great news for our industry last week, Bitcoin hitting $100,000 mark. This means that now Bitcoin is the 7th largest asset class in the world, totaling of 2 trillion market cap, highlighting the growing significance of digital assets and global financial markets. Bitcoin ETFs have now surpassed the $350 billion in trading, making BlackRock ETFs the most successful ETF launches in a 30-year history. 47% of traditional hedge funds already have access to digital assets and tokenization. The institutional confidence is driven by the confidence and regulatory uptake, with new financial projects launching either Bitcoin or Ethereum ETFs, and we have Solana upcoming. Major financial institutions like BlackRock, Fidelity, and American Express are adopting tokenization and digital assets to streamline their operations, reduce operational cost, and enhance portfolio liquidity, recognizing the innovation to outpace traditional markets. With that said, increased regulatory compliance is transforming regulatory and digital assets from a wild, wild west to a structured investment opportunity. By diversifying into alternative assets, investors gain exposure to real-time alpha, high returns with the secondary market liquidity, and building resilience against the limitations of traditional markets. Thank you.
Great, bang on time. Deborah?
Ladies and gentlemen, in a world where traditional asset classes have long dominated investment portfolios, the rise of alternative investments is redefining the landscape. Alternatives encompassing private equity, private debt, real assets present a compelling opportunity for investors. They offer diversification, potential risk-adjusted returns, and access to unique growth sectors that traditional markets simply cannot replicate. Private markets are where companies that are not listed on a stock exchange can raise capital, growth, and mature. Here, the investors have the opportunity to engage in businesses with the potential for substantial growth, often before they reach stability and maturity of public listings. The true value of a company is largely created before its IPO. This is why companies stay much longer private, and the IPOs nowadays are executed at a much higher valuation than in previous years. Private markets are where many of today's most iconic firms, such as Uber, Meta, Airbnb, or SpaceX, grew from fledgling startups to global giants. Globally, the potential in the alternative space is staggering. Consider this. While the number of public companies in the US decreased by about a third over the past 25 years, the number of private equity-backed companies increased 7 times, up to more than 10,000 companies over the same time period. This is an immense universe of untapped opportunities that only alternatives can access. Public markets no longer reflect the true dynamics of the real economies. Public companies driven by short-term shareholder pressures and quarterly earnings cycles are often disconnected from the long-term value creation that characterizes a healthy economy. Meanwhile, private companies freed from the scrutiny of the stock market can focus on innovation, sustainable growth, and the long-term well-being of their employees, customers, and communities. As 86% of the companies with revenues higher than 250 million per annum are private and achieve 64% of their revenue, it is fair to say that the real economy is built on private markets. In conclusion, private markets are indispensable to a balanced investment strategy, offering unique opportunities for growth, diversification, and innovation. By embracing private markets investment, we not only enhance our portfolios, but also contribute to the broader economic landscape's dynamism and resilience. Let us seize the potential of private markets to foster a more prosperous and inclusive future. Thank you.
Great. Again, bang on time. You would have seen Andrew is frantically jotting down notes because he's got to give the rebuttal. But in this case, I'm going to ask Spike if he doesn't mind starting his speech while you'll see Christina doing the reverse thing. So, Spike, if you don't mind, please.
Thank you. Thank you. I'm Spike. Quick introduction. 30 years in the asset management industry. We're a manager here in ADGM. Our specialities, Indian public markets, and my partner's guy in India called Madhu Keller, who's been one of the most successful public market investors for the last 30 years. Prior to that, I was in the UK before moving to the UAE and set up and ran the FTSE 100 Hargreaves Lansdown fund management company. I was one of the founders of the Scandia investment group, which became the biggest player in the UK in its sector. So to focus on this session, I think this is the dilemma that investors face. We're in a world where opportunities for growth are scarce, and probably more accurate to say opportunities for strong and predictable growth. You normally have to choose between one and the other. Many investors are lured into unknown territory when they're seeking higher returns, only to just then drown in risk. So I think one thing I've learned over the years is that the most successful investments have three things in common. One, they're built on markets that have strong and predictable growth. In other words, big tailwinds that are driving the growth, which can give you a pretty much inevitable outcome, inevitable growth if you've got a big tailwind underpinning it. Second thing you need after the tailwind is access. You need someone that can really unlock the true value that tailwind opportunity, someone that's done it for longer, more successfully, to get the most out of that potential. And the third thing is time, and I don't just mean the time that you get in and the time you get out of an investment, but the time you actually hold it. I think one of my favorite Warren Buffett quotes was when Warren Buffett was asked, how long should you hold a good investment? He laughed and he said, forever. The power of compounding was Einstein's eighth wonder of the world. So here's the thing. I think the challenge is, can you find a market that's got a really big growth trajectory, a big tailwind, and also find the best person to unlock that for you? That's the challenge for investors. Now, we're all familiar, I'm sure, with India as an investment. My simple thing on India is it really does tick that first box because it's not only a very big growth trajectory in traditional equity, but it also comes with a very high degree of predictability and certainty, provided you have the right time frame. Now, a lot of people might think that investing in India means you have to pick high-risk companies. Actually, I don't think that is the case. In the Western world in the past, if you wanted to get a 5x, 10x, 100x return, you probably had to invest in something like an early-stage biotech company or a startup company. Whereas in India, you've been able to achieve these returns with boring companies in boring sectors because they've got such a big tailwind driving their growth. So I think that I'll stop exactly on time.
Great. Thank you very much, Spike. Andrew?
Thank you. My name is Andrew Gundlach. I'm the CEO of Bleischroeder. I've been on Wall Street all my life, and there is a well-known book from the 20s by Fred Schwed, Where Are the Customers' Yachts? Where are the customers' yachts? Which means you got to be skeptical as well as opportunistic. So in asset allocation, the first question is how much risk, which is another way of saying how much equities. And the second question is how much duration, which is another way of saying how much illiquidity. The more duration, the more compounding you can take. And that is, as you said, Spike, the secret to making yourself rich. And then the second, if you've got to have less duration, there's less trading. As you know from trading, it's very hard to outperform the market. Most fund managers don't. The other question you got to ask yourself is, are you managing money at scale or not? If you're Mubadala moving $500 billion a year, that's very different than moving 5 million a year. Traditional portfolios will always have two asset classes as their core. One is the US Treasury market, which is ballast. Every portfolio needs a hedge, and that is the cheapest hedge and the safest hedge in the world. And then the second is the US equity markets, which are the deepest, cheapest, and frankly, best run companies in the world. They work and they're time tested over many, many cycles. They happen to have a network effect. Remember, markets are software, and they have a network effect, which is why you see the markets gaining share. And as a result, contrary to what the press likes to write, the US dollar also gaining share. And the dollar's digitization of the dollar via the stable coins is an additional gaining of share. So the alpha opportunities, as my colleagues on the left said, are smaller in these liquid markets. There's no question about it. But remember, 90% of your return is beta, always. The alpha spreads, of course, are also much bigger in the private markets. We can come back to that. Of course, everybody needs an alternative bucket. You could call it a fun bucket. You can call it an opportunistic bucket. You can call it venture, whatever you want. There's always a room for that. Here's the bad news for those that love those alpha opportunities as a result of illiquidity. The tokenization of these assets will make them more easy to trade, and therefore what I would call fake accounting volatility of not marking them every day will tend to go away, and therefore you'll have more of the traditional volatility.
Great. Thank you very much.
You're welcome.
So now you have heard both sides of the debate, whether alternatives are good and increasing, or will the traditional standard pieces of investments in equities you heard from Andrew and Spike? So now, again, following the mechanism that I talked about, we'll now have a rebuttal. So I'm looking at you, Christina. I hope you can get some real punches in.
Absolutely. Thank you, gentlemen. We talk a lot about risk and understanding the conversion between risk and volatility, especially in our industry, is in coloration. Risk and inherent is in all investments, but alternatives are increasingly de-risked through regulatory oversights now, especially in UAE. We have MICA and we have Asia with really strong regulatory and compliance oversight. Largely institutional adoption and us now moving into more mainstream markets with the technology advancements shows the maturity that we are just starting to enter with our markets, with major players moving into digital assets and tokenized alternatives. With tokenization, we are also transforming liquid assets into tradable units, enhancing the liquidity, which is great for secondary markets that private securities and public sectors don't have. Additionally, family offices can balance their portfolios with liquid alternative products that are fully regulated, and we have heard today with Bitcoin and Ethereum ETFs. And lastly, while digital assets have shown significant growth and resilience with increasing institutional adoption, providing confidence, early adoption for family offices allows them to capitalize on this emerging markets before it matures. So my question is how family offices are ignoring tokenized and digital assets with the alpha that we provide, driving the younger generational and future-proofing their wealth.
Great, good points. Andrew.
So let's talk about some of the themes that have been brought up here. One is risk. Risk is not volatility, unless you believe in the academic CAPM model. Risk is very simply the permanent loss of capital, which is the way Buffett and most serious investors look at it. Number two, diversification. Venture and alts are not diversification. If you track venture, it has the more the NASDAQ goes up, the more venture capital companies raise money with a confidence and correlation factor about 0.8. So VC is essentially the NASDAQ on steroids. It is not a diversifier. Let's also talk about the illiquidity discount. I'm on the faculty at Columbia Business School. I'm also on the board, and I work with the endowment officer there. And the former endowment officer is now at Harvard. When Columbia looks at alts, it starts with a 3.5% per annum illiquidity hurdle. Ken Griffin, arguably the best hedge fund manager in the world and certainly one of the best CEOs, thinks that's way too low. He doesn't want to give up illiquidity when he can trade in markets. So what's the cost or what's the price of illiquidity has never been agreed upon, but it's not zero, that's for sure. It's quite high. Lastly, if you think about Bitcoin for a second, there's no question it's getting bigger, no question about it. And the dollar coins are taking serious share from a 1950s technology called SWIFT, which bothers us all when we move money across borders. There's a traditional way to play Bitcoin, which won't be as sexy. It's called Amazon. AWS is the base of all of these currencies, and it will grow, essentially dollarizing and digitizing these markets. So let's also go to alpha for a second. Last point. The alpha spreads in the private markets are massive, truly massive. I just happened to be at the Mubadala Capital LP meeting on Friday. They have 200 people. It's a first-class firm in every way. I live in New York, where Blackstone, Carlyle, et cetera, have similar types of extremely intelligent, extremely well-paid people. If you think on your own, you're going to be able to outperform them in the private markets, be it real estate, venture, et cetera, this is a scale game. There's no question about it.
Great, thank you very much. So here we go. You heard the opening statements from both teams about the traditional assets as well as the alternative assets, and then you heard the rebuttal. Now, let me just try and summarize this in a few words from my side. First is when you look at family offices, you have to realize that most of them actually have their own family businesses. So if you're talking about where they have invested in, especially the first and the second generation, a substantial amount of their wealth is actually in their family business. The second thing that you have to understand, and that in a way has to be considered slightly separately. The next thing, and especially if you're looking at the Middle East, you generally have got two major areas where the family offices have invested, and we are sponsored by UBS, and their recent report actually gives credence to this, is that a substantial amount of their investments, maybe about 50 or 60 of the remainder outside the family business, is in public equities and fixed income. But then a huge amount of their investments also go into what I would call as real estate. And that's where the liquidity and the risk element comes in differently. And especially if you're talking about Middle East, the financing of real estate acquisitions or investments are mainly done on leverage. But then the final point from the perspective of alternatives over here, and we are sitting in Abu Dhabi, which, as it says, capital of capital, yes, a huge amount of money and the investments is going into public markets, but the availability of alternative investment sources over here, whether you're talking about virtual assets, whether you're talking about hedge funds, whether you're talking about tokenization of assets, this place is absolutely growing like crazy. So I was hoping that we would have some kind of a voting system which would allow the House to actually vote on this. But I'm going to say that I think each of us has to take a decision, and whether you're yourself investing your money or advising your families and your clients to invest, hopefully the points that my colleagues on the alternative side or on the traditional side have given you some food for thought. Thank you very much, my colleagues, on both sides, and thank you for listening.
Thank you.